You've probably done this before. You get a bit of extra cash and figure the smartest move is to toss it at your mortgage. And it feels responsible. One extra payment a year, and suddenly you're shaving years off the loan. In theory, at least. But here's the problem. If you don't handle that payment the right way, your bank can sit on it, misapply it, or even charge you fees for sending it in. It sounds crazy, but it absolutely happens all the time. So in this video, we'll be talking about the 5 critical things you must check with your lender before you send a single extra dollar toward your mortgage. You'll avoid wasting money, avoid unexpected fees, and actually get the faster payoff timeline you're trying to achieve. Remember, banks profit from earning interest, so your good intention isn't always their priority. So let's make sure your money is actually working for you. Item number 1, prepayment penalties. Some mortgages, especially certain older ones or specific loan types, have a prepayment penalty. This is a fee for paying off the loan too early, or even paying too much extra within a certain period. It seems unbelievable that banks may want to stop customers from giving them money early, but paying extra reduces the loan tenure, which reduces their interest collected, which reduces their profits. From that perspective, it's easy to see why they may want to discourage early payments. So, check your original loan documents or call your servicer. It's a must to understand the terms before you pay a cent extra. Item number 2, how do you pay? Not all extra payments are created equal. Some banks let you add an extra amount right in your regular online payment. Others require you to make a separate, designated principal-only payment. And amazingly, in this day and age, some still require you to call them and give specific instructions. If you just add it to your next monthly payment, it might just prepay interest, not reduce your principal. So knowing how to pay extra is critical, which leads to item number 3, where's your payment going? This is the most important technicality. You must ensure the extra payment is applied to your loan principal, not to future interest or just held as an advance payment. The magic of saving interest by reducing the loan tenure only happens when you reduce the principal balance. If it's just sitting as an advance payment, for example, it isn't going to do anything to reduce your loan duration. It just means that next month's repayment is already sitting idly with the bank. So, in your instructions or online portal, look for the words "apply to principal." If you're unsure, call and confirm in writing after you make the payment. Item number 4, fees everywhere. Banks do love their fees. Which of us hasn't been dinged by a 10 or 20 buck hit for paying our cards just a day after the due date? So, it may not be a surprise that some institutions charge a processing fee for the service of letting you pay them early. It might be a small flat fee or a percentage. Check your fee schedule. If there's a fee, it might make sense to save up your extra payments and make one larger lump sum payment once or twice a year to minimize those charges. In the meantime, sock it into a high-yield account or deposit, or even use it as your backup emergency fund so that the money doesn't go to waste. Item number 5, timing and frequency limits. Finally, check for limits. Some loans cap how much you can prepay per year. For example, 20% of the original balance. Others limit how often you can make extra payments. For example, once per month or statement cycle. Understand your lender's rules so that your strategy fits within them. Paying off your loans early is a great perk of having excess funds, but sometimes there may be better ways to use that money. So check out this video next on 7 things to think about when deciding whether to use your extra cash to pay off your debt or to build your savings.